One of JP Morgan's top strategists expects stocks to rally more than 5% between now and early next year. Marko Kolanovic is the global head of macro quantitative and derivative strategy for JP Morgan. He's also known as a man who moves the markets. Marko, it's always great to have you with us.
Thank you.
You and the firm's chief U.S. equity strategist had a mid-year 2020 target, and you actually pulled that forward.
Exactly. We pulled it a little bit forward, 3,200. So it's about 5%, as you said. We think actually it could happen even late this year or sometimes in the first quarter. So overall, we are positive. Reasoning, you have a synchronized easing from central banks globally that tends to lead by 3 to 6 months. So we think actually this the inflection could happen now. So if you look at the manufacturing PMIs, they're pretty low. We have a manufacturing recession right now. Historically, whenever you have this type of synchronized easing, you do see actually turning PMIs. So positioning also we think is relatively low. So everybody is a bit hesitant. Everybody's in defensives, and also net exposure is not that high. So we think positioning plus central banks. If you can add to that a bit of a positive news and developments on trade, which seems like it's happening, you could have this seasonal end of the year rally, certainly in the first quarter when investors take new positions. We think we'll see that 3,200.
You actually think that there's a bubble in the defensive stocks. So which areas within defensive are you most concerned about?
So it's generally stocks which have low volatility. So that low volatility investment style become very popular over the past few years. So basically you pick any sector and just take the stock that has like a lowest perceived risk by lowest realized volatility. So that's one approach. If you want a little bit more kind of sectorize it, it would be basically bond proxies, so utilities, staples, REITs, also mega caps that are kind of like very stable and safe. So everybody piled in there a little bit as the yields decline, sort of from 3% to where we're now 160, 170. Investors moved actually into the bond-like equities. So they basically look at everything that's similar to, whatever is similar to bonds, but has a higher yield, they'll go into that.
So Mark, I'm curious, you pulled forward your estimates. Does that imply then the rest of 2020 doesn't look so good to you?
So we will have elections next year, and I think there's going to be probably some interesting development between then and now, so it's very hard to have any visibility sort of November next year. So we're basically saying, look, we can actually rally now. Next year, we will start assessing these probabilities for different candidates, different developments, and we'll form a view based on that, So seasonality works for you also in the fourth quarter. Historically, it tends to be the strongest quarter.
So, Marko, how did you get to that number? Was it a change in the multiple, change in the earnings, or both? Or
it's a combination. It's a combination of both, And then we also do look at the sort of positioning and potential market impact if investors were to get to some sort of average level of historical positioning. So it's combination of those two. For earnings, we think probably Q3 is where we're seeing bottoming of the earnings. Q3 is the toughest comparison year over year. I think fourth quarter is going to be already a little bit easier comparison, not just for earnings, but also for some of the economic numbers, as well as some of our technicals. If you look at the trend for different sort of commodities or equity indices, will turn a positive sort of when we start benchmarking off of the fourth quarter last year.
There's an argument out there, Marko, that all the Fed easing hasn't gone into the system yet. So we have 3 Fed rate cuts. Do you think that we've seen any of that impact yet? And do you think that impact would be enough to maybe bolster stocks beyond your 3,200
well, yeah,
target?
Possibly. I think 32 is, as you said, about 5%. That's not a huge upside. Yeah. Actually, we are a lot more positive on rotation away from defensives and into cyclical. There, we actually think you can get some double-digit type returns. So is it possible the market goes higher? Yes, again, given sort of amount of easing, given where the yields are, if you're going to relative evaluate equities versus bonds, it could actually go higher. But, there is also a lot of uncertainty. There's, as I said, there's a gap of valuation. There's stuff which is very expensive and stuff which is very cheap. So if you kind of like converge those two a little bit, so we don't want to go with some very high number.
But you like the stuff that's really, really cheap.
We like it. We like it, and it's been a bit of a disappointing. This summer was very tough. We saw actually rally in September and October of value. Still, actually, we think there should be a lot more to go. So we like stuff which is very cheap, which is in the gutter, abandoned. So high volatility stocks, cyclicals. Sector-wise, those would be energy, materials. So kind of everything that everybody stays away. We like it.
All right, Marko, great to see you. Thank you, Marko Kolanovic, JP Morgan. Do you like Marko's gutter trades?
Yeah, listen, back to your glass half full. I mean, listen, this long base since 2018, that October high with these slight incremental highs, it looks like a nice little base. And if you get a lot of things falling into line, a trade deal that people actually like, and there's some substance to it, Brexit is not a disaster, and a couple other things, then you have a market that's breaking out from this thing because expectations are low still, and then you have this situation where the comparisons get easier. So I can see that. I'm just telling you, over the last year, it has not been a great time to buy stocks at new all-time highs. It's just that simple.
Well, I tell you what, the rotation that Marko referred to that we saw in August, I think we're in one now. And I think we've maybe taken a breath over the last couple of days. But that has included banks, that has included transports. I would think FedEx has to fall into his gutter trash being cut in half and trading at a trough multiple. It doesn't mean that you have to think global PMIs run away from you. You have to just go from terrible to bad to stabilizing. And maybe not even for a long time, but we've started to see some signs of that. And I think that's encouraging.